for a few days. Here's my projection. I think that silver is going to, one, outpace gold now going forward and regain normalcy versus gold. I specifically think silver could go to, right now it's like 1%, 1.1% of the price of gold. A lot of people measure it the other way, but we do it, we divide silver into gold. I think it'd go to 2% easily. Well, that's almost a doubling the current valuation level of silver to gold. Okay, so that's one background hint. Of course, that doesn't tell you about price. It just says silver's going to beat gold by doubling its gains over the next, whatever, I think in the next 3 to 5 months, silver's going to blow out $50. Wow. Those are old phantom highs. And when I say phantom, what I mean is when you go back and look at them, one of them didn't even quite get to 50, but let's call it 50. You stayed up there for hours, not months, okay? It was like gas, thin air, and immediately relapsed. So it really wasn't up there for long. And two, when you factor in the decay in the money unit, the real value of the dollar, 1980, 2011, we could be at $200 to match those highs. Real dollar terms. Okay. But right now, I suspect that the first surge that we're getting, that has begun, I'm not waiting on any more numbers, in the next 3 to 5 months will get you well above 50, likely into the $60, $70 range. Now, that's not the end of it, but that's the...
Gold's grabbing headlines, but silver just crossed a critical breakout level. Silver has surged over 31.4% year to date, briefly surpassing $38 per ounce for the first time in over a decade. Although gold has also performed exceptionally well, rising approximately 28% year to date and hitting new highs, many market participants are starting to consider whether silver's unique combination of industrial utility and monetary history gives it the edge moving forward. With rising inflation, geopolitical turmoil, and global debt concerns weighing heavily on markets, the appeal of precious metals as a store of value remains undeniable. Silver, with its comparatively lower price point, is becoming a more accessible option for a broader range of investors. But what happens when the world realizes there's simply not enough to go around? Legendary analyst Micheal Oliver says this is just the warm-up. In fact, he's predicting a violent surge to $60 to $70 in the next 3 to 5 months, with the potential for $200 plus in the long term. Today, we reveal exactly why this move is about to accelerate and how the coming dollar collapse will light a rocket under silver prices. This is not speculation. It's certainty. Let's break it down, but before we continue, please subscribe to our channel and hit the notification bell for more timely updates. Thank you and enjoy the video.
Great to have you. And really, I wanted to have you on to talk about silver market. You've had some great calls that it looks like to be working out in the silver market here. That being said, want to know where your thoughts are, where we currently are at, where we're going, and if this run is over with.
No, the run just began. If you go back and look at a silver price chart, just what idiot chart I call it, because it's just price, okay? I go back to last May, silver hit a high at $32.70, okay?
Right.
Then came back up in October, hit $35, dropped. Came back up in March of this year, hit $35, dropped, okay? But if you draw a line through the May high of last year, you can intersect most of the action, all the action over the last year, okay? May to May. We've been above it, below it, but it just basically hovers around that midpoint. You had a plunge that cleaned everything out, that fake out sell-off to $27.50 that occurred in the first week of April, where silver thought it should be part of the stock market. And no, okay, anyway. Silver, during that year of nothing on price, where it just looked like confusion, on momentum, you get a different picture, which we, of course, include in our reports. That's our prime focus. You had a downtrending channel on momentum that smacked you in the face. When you looked at it, you said, whoa, if I get above that channel, I'm breaking out. Okay. When we came back up to 34.90 a week ago, not back to the 235 peaks at 35.20 and 35.40, whatever they were, but just below there, you blew that channel out on momentum. It says, okay, I'm awake again. Which what you've seen for the last year is noise. Me correcting by going sideways. And suddenly you go to 37. Okay, then you back off a bit. Now you're mid 36s. Okay, you're cooling off for a few days. Here's my projection. I think that silver is going to, one, outpace gold now going forward and regain normalcy versus gold. I specifically think silver could go to, right now it's like 1%, 1.1% of the price of gold. A lot of people measure it the other way, but we do it, we divide silver into gold. I think it'd go to 2% easily. Well, that's almost a doubling the current valuation level of silver to gold. Okay, so that's one background hint. Of course, that doesn't tell you about price. It just says silver's going to beat gold by doubling its gains over the next, whatever, I think in the next 3 to 5 months, silver's going to blow out $50.
Wow.
Those are old phantom highs. And when I say phantom, what I mean is when you go back and look at them, one of them didn't even quite get to 50, but let's call it 50. You stayed up there for hours, not months, okay? It was like gas, thin air, and immediately relapsed. So really, it wasn't up there for long. And two, when you factor in the decay in the money unit, the real value of the dollar, 1980, 2011, we could be at $200 to match those highs.
Wow.
Real dollar terms. Okay. But right now, I suspect that the first surge that we're getting, that has begun, I'm not waiting on any more numbers, in the next 3 to 5 months will get you well above 50, likely into the $60, $70 range. Now, that's not the end of it, but that's the next surge. And I think it will be quite dramatic. I mean, obviously, if you go there, that's a big percent gain in silver over such a small period of time. But I think between now and later in the year, we're going to see somewhere $60 to $70 silver. And again, that's not the end of the move. That's just this surging leg. And I see silver outperforming gold during that time. And I also see the gold and silver miners outperforming gold during that time.
Got it. Okay, so really what you're talking about, correct me if I'm wrong, I don't want to put words in your mouth. You're talking about the gold and silver ratio. You see that ratio compressing significantly then over the next few months, correct?
Yeah. Again, I measure it a different way. I simply divide an ounce of silver into gold, 1 ounce. And right now you're 1.1%. If you go back over the last 50 plus years and look at each year, what was the best reading that silver had each year at some point in that relationship to gold? 2% is almost normal. It occurred like 21 of the last 50 years. Silver's at least been 2%. And those weren't necessarily even dynamic bull trend years. In the more dynamic bull trend years, like 1979 and 80, or 2010 and 11, silver got up to 3.5% and more, the price of silver. Well, just forget the price of silver right now and gold. Just look at that spread and say, well, gee, I'm going to buy something at $1.10 and it's going to go to $2. Okay? That's nearly a double just in the relative performance.
Right.
I say go to $2. That's not even some outlandish norm. That's the norm. 2% is like a median for 50 years. And given that we're in a bull trend, we could go further than that. But right now, I'm focused personally on this particular leg, in part due to the fact I'm also heavily into calls. And calls have time sensitive. But I do think in the next 3 to 5 months, you'll get that kind of dramatic, I'm out of here move. Not that that's the end of the move, but that is the surge that I'm looking right now. And I think that it's about to unfold. And there's some other events in other markets that are also at what I would call major snap points.
Silver had been trading in a tight range for over a year, which often frustrates investors. However, Micheal Oliver's momentum analysis, which looks at price behavior relative to its moving averages over time rather than just price alone, showed a hidden bullish signal. Breaking a long-term resistance often marks the start of a major upward move. The gold/silver ratio is currently around 90 to 1, meaning it takes 90 ounces of silver to buy 1 ounce of gold, historically a very high number. In prior precious metal bull markets, this ratio has collapsed to around 50 to 1 or even 30 to 1, which means silver tends to outperform gold 2x to 3x once momentum kicks in. This is due to silver's smaller market size and higher volatility. If the ratio drops to 50-1 and gold holds steady, silver would need to double in price from here. If gold also rises, silver's upside could be even greater. Apart from the gold-silver ratio, the US dollar index, which measures the dollar's value against a basket of major currencies, shows that the 98 level is psychologically and technically important and has acted as a floor or support for decades. If the dollar closes significantly below this level, it would indicate the start of a long-term devaluation trend, potentially due to rising debt, weakening confidence in US monetary policy, or global de-dollarization. A 10 to 20% decline in the dollar would raise import prices, stoke inflation, drive foreign capital out of US equities and bonds, cause a flight to hard assets like silver and gold, which typically thrive when fiat currencies weaken. Also, US Treasury yields is the cornerstone of global finance. The 10-year Treasury note, in particular, influences mortgage rates, corporate borrowing, and equity valuations. Micheal Oliver is warning that a further rise in 10-year yields, that is a drop in bond prices, would trigger a panic in the bond market. If that happens, the Fed may try to intervene by buying bonds to suppress yields, but with persistent inflation, they could be limited. Investors will seek protection in tangible assets like silver and gold, especially those with industrial and monetary uses. This scenario implies a loss of faith in both bonds and the dollar, pushing investors into real, finite assets, where silver stands out due to its dual utility as both a monetary asset and an industrial asset.
What other things, if you mentioned other markets that you analyze and looking at, that could impact this move? Talk to me about that, because I can see that or be influencing the money flow.
Yeah. Often when something like this happens that we're describing in silver and the gold miners, it doesn't happen in isolation. Whereas they might have been going up for years without much events elsewhere. But when you get to this point where you start to accelerate headline type behavior, usually there's other stuff going on. And technically speaking, the crossover we just had in silver a week ago, that momentum chart I told you about, the fresh snap to the upside, boom, fresh again, okay? But I go over and look at certain other key markets, for example, the T-bond market. It's got a level below it that looks like that somebody's trying to support it. The buying, the tonal behavior of the market is shifted into a unusual behavior, as if central bank governments in there trying to keep it from bursting through a level. And frankly, they're bidding at right spot, because if it gets much below the lows we just saw, we argue you could get an implosion that would make headlines. Now,
that would never happen.
yeah, no, yeah, right. It's an unreality. It'll stay an unreality, right? We could have government debt forever. No big deal. Okay. The other market to watch is what we call the quiet one. That's the dollar index. We know that all the fiat currencies decay at aggressive rates every decade. Our money supply grows by 90% almost every single decade, going back to the 50s. Meaning its value drops almost 50% every decade. It's real buying power. Okay. So if you bought a stock 50 years ago and you're up fivefold, you're not making any money. Okay. It's a joke. In real, how many loaves of bread will it buy? It's the same amount it bought then. Okay. The dollar index reached a high back in October of 2022 at 115. That was a nice little spike high, still well below levels we saw a couple of decades ago. Okay. It collapsed from that level in late 2022 into early 23 and stopped at 100. Again, the dollar index is primarily a weighting of the euro and the yen. They constitute over 70% of the inverse of the dollar index. Okay. Since 23 and 2024, it stayed in a range of about 8%, 100, 107, 8, 100, 107, 108. Actually pierced up to 110 briefly and then failed. In March, as we were pulling back, price was 104, just above 104. We said, that's it. It's over. It's entering a major bear trend. That was based on one of our annual momentum studies. We've since dropped another 5-6 points around the 98 level, just like a month ago, rebounded up to 101, like, oh boy, I'm okay. And now it's back under 98 again. Again, not super dramatic price movements. And also the percent move is not that huge yet. even from that range, we're only a couple percent below that multi-year range. But momentum broke a structure going back a couple decades. There is another momentum trigger level we have that is a monster. It's based on 10-year average, and it happens to agree with where the average is itself. In other words, you get below that average and close a month, you'll actually be blowing a trend structure that you could plot on an oscillator. It's not just getting below an average, it's blowing a structure. And if you saw the momentum chart, so if that were a price chart, you'd be getting short, okay? We're below there now. Well, 98.35 is the number. You close out this month below 98.35, and right now we're below 98. Quiet, no big deal, no headlines. You're going to accelerate the downside in the dollar where it's suddenly going to be a player. It hasn't been a dynamic force yet because it's been in such a narrow range. Suddenly it will start to make waves, and such waves as, for example, we've got the largest amount of foreign investment in the U.S. stock market ever last few years. Well, if you're a foreigner and you buy in the U.S. stock market, you own it in dollars. Mm-hmm. So not only does the S&P movement or whatever stock you own matter, but also the underlying money unit. If it suddenly drops 10% and the market goes sideways, you just lost 10%. Okay. So that's going to upset some owners in the stock market, but also the U.S. government bond. Just can't afford this continued process of abandonment of U.S. debt by foreign governments. And when you break that dollar more sharply, the pain for them gets even more if they're still hanging around in the bond market. So that could help accelerate that. But what's so interesting is that the bonds are just above a level that we think is precipitous collapse, 110 to be precise. It's been down under 111 recently. And the dollar index is trading below a number it can't close the month below. These two factors could suddenly get into gear in a more violent way and have wave effects that weren't the topic of discussion of the last few months, which is the tariff stuff. Suddenly, something else impacts you that you weren't looking at. That's the greatest ambush effect you can get in a market. It's when you're ambushed not by what you're focused on, but on something else that's also significant. And it's so interesting that silver just crossed its line a week ago, simultaneous with these two other big key markets about to cross their lines. So I don't think it's coincidental.
Yeah, I don't think so either. It is really interesting. Real quick comment about this has implications for the yen carry trade, which seems like it's really drastically ending, which also would impact all. Well, I don't know if that's the chicken or the egg, if you would comment.
Well, they're in similar shape we are, in worse shape debt-wise. And the point is that now us and them, it's suddenly not just some country over there. It's also, Jamie Dimon has made the point over and over, not only is this, we're going into the recession, but that bond market is, we're at the point now where unreality of decades is suddenly going to pay its dues. There's only a point at which you can keep faking reality, like a stock market bubble high or whatever. You can only go so far in excess or inverted. There's only so far downside you can go with miners versus gold. And reality takes over and says, hey, that was a mistake. Whoosh, upside. Or the case of the stock market and bonds and the dollar, whoosh to the downside. So, and when reality hits again, it's usually not the headline that everybody thinks is the headline. All of a sudden, that's out the side window. Oh, my God, a major commercial real estate company just went under. Oh, it impacted this bank. You get the point.
Yeah. Well, Michael, well said again to all of our viewers. I am a very happy client and a reader of Michael's work. Michael, give us your website. How do people get in touch with you and how do they buy your services?
Well, it's Oliver MSA from Momentum Structural Analysis. Take your time, tool around. We go in some depth on what is our unorthodox methodology and why did we do it? What's the justification for having a different sort of technical methodology? We explain it there. A lot of archived reports. We cover all four major asset categories. We don't just look at the stock market or gold. You've got to look at everything. The bond markets, foreign exchange, they integrate, sometimes more so than others. I think we're there. I think we're at one of those points in history where never before has the wave effect of one upon the other been so great. Anyway, fun times.
Sometimes
The bottom line is that momentum and technical patterns are turning bullish for silver. A weakening dollar and bond market stress could force a flight to precious metals. Silver's industrial use plus its role as a store of value gives it a unique edge in this inflationary, uncertain environment. Historical patterns suggest silver outpaces gold in these cycles. Current price levels may be dramatically undervaluing silver's real-world demand and scarcity. If these scenarios play out, silver has the potential to deliver asymmetric gains, especially when traditional financial assets, stocks, bonds, and fiat come under pressure. Whether you're a stacker, minor investor, or survivalist, this is your wake-up call. Drop a comment. Are you buying silver now? Smash that like button, subscribe, and hit the bell to get more insight and deep dives like this.